If you're going to invest in the stock markets, I'm going to tell you the one index fund, an ETF that I believe that everyone should have. And first, I want to tell you this. You know that I'm not going to BS you. I will tell you sincerely that most stock market investors are better off investing in index funds and ETFs. So listen, if some people are trying to get rich quickly with stocks and you want incredible gains, then I don't want to ruin your fun. So I'll tell you this. You don't need to put all your money in index funds or ETFs. You can do what I do. Have a good portion of your money in index funds and ETFs and use some of your money to pick individual stocks. Or if you just want to stick with just index funds or ETFs in the stock market, that's fine too. So listen, I'm going to be very direct with you. Investing in index funds or ETFs is awesome because it's a set it and forget it type of strategy. That means that you don't need any expertise, you don't have to manage it, you don't have to stress out about it. So even Warren Buffett says that most investors are better off using index funds instead of trying to pick stocks. So I'll tell you this story really quickly. In 2007, Warren Buffett made a wager. Buffett made a bet with a New York City money management firm that over 10 years, an S&P 500 index fund would outperform 5 hedge funds. So fees and expenses would be taken into consideration. The wager went from 2008 to 2017. After the 10 years, the hedge funds had an average return of 36% over those 10 years. So that's about a 3.6% return a year. So Buffett went with the Vanguard Index Fund tracking the S&P 500, which went up by 125%. That's 12.5% a year. After the wager, Buffett wrote a letter to his shareholders. He said that small and large investors should stick with low-cost index funds. Now, I'll tell you this. The downside with index fund and ETF investing is that you will not beat the market. So if the market goes up 10%, then you're going to make 10%. If you want to get rich quickly, index funds and ETFs may not be right for you. If you want to act like a maniac, then index funds and ETFs will most likely disappoint you. If you want to learn more about index fund investing or the differences between index funds and ETFs, then check out my videos that I made about that. I'll leave a link for you down below. Now, the one index fund or ETF that I encourage all stock market investors to own is one that tracks the S&P 500. So here's some of the top S&P 500 index funds. So you can go with the Vanguard 500 Index Fund Admiral shares. So this was founded in 1976, and it gives you exposure to 500 of the largest US companies. Another option is the Fidelity 500 Index Fund. So the benefit of this one is that there's no minimum requirements, so any investor can buy into this fund. Now, another option that you have is the Schwab S&P 500 Index Fund. So I would say that the biggest benefit of this one is that this is one of the cheapest S&P 500 tracking funds out there. So this was founded in 1997. This fund charges 0.02%. That's the expense ratio, and also no minimum investment. Now, I want to show you the performance of these index funds. So here's the Vanguard 500 Index Fund Admiral shares. So this is the Fidelity 500 Index Fund and the Schwab S&P 500 Index Fund. Now, let me give you the top ETFs that track the S&P 500. So I'm showing you ETFs because some brokerages do not allow you to buy index funds or have a minimal selection of index funds. So there's the SPDR S&P 500 ETF Trust, SPY. So this was launched in 1993, and this ETF is the largest ETF fund by net assets in the US. It's the original ETF. So the net expense ratio is 0.0945%. So that means that the management fee will be $9.45 on every $10,000 invested. So the SPY is not the cheapest fund. However, it is the most well-established. It's the most liquid in the entire stock markets. Now, another option for you is the iShares Core S&P 500 ETF, symbol IVV. So this ETF is the second largest ETF in the US. So the IVV and the SPY, they're nearly identical in holdings, but if you're just gonna buy and hold, honestly, this may be a better option for you. That's because the IVV charges an annual expense ratio of only 0.03%. So that means that you're going to pay $3 on every $10,000 invested. That's about 1/3 the annual cost of SPY. Now, another option for you is the Vanguard S&P 500 ETF. So this is the third largest ETF by net assets in the US. So this ETF, it's nearly identical to IVV. The holdings are similar, the performance is similar, the expense ratio is similar. It's just another option. Now, I want to show you the performance of these ETFs. So look at the first one, SPY. This is the IVV and VOO. So having an S&P tracking index fund or ETF is an absolute must, in my opinion. But if you want exposure to a specific sector, then you can do that with an index fund or an ETF. So let's just say that you wanted more exposure to the energy sector. Then you could invest in the Energy Select Sector SPDR fund, symbol XLE. So this portfolio owns 23 holdings across the S&P 500. It gives exposure to oil, gas, fuels, energy equipment, and energy services. Let me show you XLE's performance. So as you can see, that may look like an ugly chart to some people, depending on when you got in. Obviously, it's much more volatile than an index fund or ETF that tracks the S&P 500, but you have this option available to you. Now, let's say that you think that international stocks are going to do well over the next few years. Then you could invest in the Vanguard Total International Stock Index Fund Admiral shares. So this international equity index fund provides exposure to Europe, the Pacific, and emerging markets. So here's the performance. I know that it doesn't really look that appealing, but hey, if you're looking for international exposure, then this is an option. Now, another option would be the Schwab Emerging Markets Equity ETF, SCHE. So this international equity ETF provides exposure to Brazil, India, Taiwan, and China. So here's the performance. I would say, yikes. This one is really not that easy on the eyes, but it's an option for you. I'm not recommending it, just giving you some examples. So let's say that you wanted more exposure to the NASDAQ. Then you have the Invesco QQQ, symbol QQQ. So it's an index fund that tracks the NASDAQ and holds over 150 billion in assets under management. So here's the performance. So yep, this one's looking much better. And I'll throw some additional ETFs out here just to give you some examples. So let's just say that you wanted real estate exposure. Then you can go with the Vanguard Real Estate ETF, symbol VNQ. Same thing with utilities, XLU, or healthcare, VHT. So as you can see, if you're looking for a sector-specific index fund or ETF, you can find them. Now, I want to close with this. Regarding an index fund or ETF that tracks the S&P 500, in the short run, sure, it might go down. However, if it's a long-term investment, then you saw the charts. Stick your money in there, set it and forget it. No skills required, no management required. Lower stress and anxiety. In my opinion, that's the best one for a core position. I hope this information helps. Please subscribe. Thank you for the support, and I wish you a very nice day. Take care.